Thank you, Mr. Dimon, for your testimony. As we begin questions, I ask the clerk to put 5 minutes on the clock for each member. Mr. Dimon, there was clearly a breakdown in risk management at your firm. What did you do, when you made your tempest in a teapot comment? Why were you willing to be so definitive a month before publicly announcing the losses when it appears you did not have a full understanding of the trading strategy?
Let me first say, when I made that statement, I was dead wrong. I'd been on the road, I had called Ina Drew, who ran the CIO. I'd spoken to our risk officers, our CFO. They were looking into it. There were some issues with CIO before April 13th, we announced earnings. I was assured by them, and I have the right to rely on them, that they thought this was an isolated, small issue and that it wasn't a big problem. They look at things like how bad can it get, they stress it, and under no event it looked like it would be getting nearly as bad as it got after April 13th.
Mr. Dimon, there were reports that the CAO had scrapped a risk limit that would have required traders to exit positions if losses exceeded $20 million. Is this true? If yes, did you approve this, and why was the limit removed?
There was no loss limit, I know, $20 billion.
$20 million.
How much?
$20 million.
Billion.
With an M.
No. Million. Million.
Yeah.
No, I'm not unaware of a $20 million loss limit. CIO had its own limits around credit, risk, and exposure. At one point in March, some of those limits were triggered. The CIO at that point did ask the traders to reduce taking risk, and she started to look very heavily into the area, which is the proper thing to do. Sometimes triggers and limits do get hit, and what should happen afterwards is people focus on it, think about it, and decide what to do about it.
There have been concerns raised about the change made in the CIO's risk model. When were regulators notified? Why was the risk model changed? Did this change mask the true risks of the trading activity?
So what I am aware of is that sometime in 2011, the CIO had asked to update their models, partially to get them updated to be compliant with the new Basel rules. Model reviews are done by an independent model review group. They started the process 6 months earlier, and in January they did in fact put in a new model. I should note that models are changed all the time, always being adjusted to try to be better. Inform yourself of the past and try to make models get better. The models were approved by the model review group, were implemented in January, and did effectively increase the amount of risk that this unit was able to take. When on April 13th, we were still unaware that the model might have contributed to the problem. So when we found out later on, we went back to the old model. So the old model was more accurate in hindsight than the new model we thought it was going to be.
Reports suggest there are multiple warnings of weak controls at the CAO that were ignored. In your testimony states that your trading strategy was not reviewed outside CIO. Did you, Mr. Dimon, make the decision to exempt the CAO from any review of risk controls outside of the unit? Or why was no one watching?
I think the first error we made was that the CIO unit had done so well for so long that I think there was a little bit of complacency about what was taking place there and maybe overconfidence. It did have its own risk committee. That risk committee was supposed to properly overview and vet all the risks. I think that risk committee itself, while independent, wasn't independent-minded enough and should have challenged more frequently and more rigorously this particular synthetic credit portfolio. I think the second related risk is that the synthetic credit portfolio itself always should have had more scrutiny. It was higher risk, it was mark to market, it should have had more scrutiny and different limits right from the start.
Mr. Dimon, did the pay structure for the employees at the CIO incentivize risky behavior that led to the massive trading loss instead of rewarding those who reduced the bank's risks? Were there bonuses for generating profits out of the CIO? Will you seek clawbacks from traders, management, and executives involved in this trading debacle?
So I think, let me just give a big picture about compensation at JPMorgan. To start with, we don't, and have not had for 5 or 6 years, special severance packages for executives, change of control, parachutes. There was no one in CIO who was paid on a formula. The management of the CIO portfolio was subordinated to the rest of the company. They were not allowed to do what they want. They couldn't invest very long. They couldn't take too much high-yield exposure, et cetera. They were paid for what they did for the whole company. And when we pay people, everyone, we look at their performance, the unit's performance, the company's performance, and their performance includes recruiting, training, integrity, sharing with senior management, all the things that we need to do to make it a better company. So I don't believe that the compensation made this problem worse, and like I said, none of these folks were paid on formula. Oh, your second question was clawbacks. When the board finishes a review, which I think is the appropriate time to actually make those final decisions, I think it would be inappropriate to make those decisions before you finish your final review, you can expect that we'll take proper corrective action, and I would say it's likely, though this is subject to board, but it's likely there'll be clawbacks.
Senator Shelby.
Thank you, Mr. Chairman.